So I think without further ado, John, over to you, and we very much look forward to hearing from you. Thank you.
Great, thanks, Adrian. I was saying before this call started how I was disappointed that Adrian's worn a tie, and I'm here in my jumper looking much more scruffy than him. But if there's other accountants and lawyers on this call, then it will come as no surprise because we feel naked without. So I've just pulled together a few slides to take you through, which gives a bit of context really to what I was hoping to talk about. So I was going to rattle through a few of these in the first instance, just to sort of set the scene, if you like. And it might help if people have got specific questions on the topics I cover, or those that I don't. It just might help prompt those as we go through. So I won't dwell on this for too long, but what I wanted to talk about was cash flow planning, how you do it, and why people are doing it now, and why it's very important. And I find that's very linked into the next part of it, which is where there is a funding requirement for businesses, what support is there available at the moment to try and fill those gaps, if there are gaps, A, from the government, or maybe B, not from the government, through more traditional funding routes that have always been available. And whether the question is there, whether or not they're still open for businesses. So that's what I'm going to rattle through here now. I think we all know this context very well. I mean, in my experience of this has been going on for a few weeks, but it feels like a bit of a lifetime, really. And the pace of change and speed of events and speed of announcements has been really fast. And so, and we're all living through that and trying to work through it. So I think we all understand the context quite well. I think what we don't know, and certainly I haven't got the answer for you, unfortunately, is what the recovery might look like. And it's really relevant to what I'll go on to talk about. And you hear these letters: is it a V-shaped recovery, a U-shaped, or an L-shaped, or sort of an X recovery? And my assessment of that is, I think it'll be all of those. I think different sectors will recover at different speeds quite clearly. And whilst it might be consistent around recovery, I think what is very consistent today is the focus on cash is absolute, for everybody, and it includes sort of U&W and professional services firms in that too. It's very important. And the question that I've been wrestling with here, and this is mainly around sort of help businesses access funding, is I don't think the funding need necessarily is just to fund or help businesses to survive where we are today and trading through the lockdown period. I think it's an awful lot about that, but also, well, when it's finished and when the businesses are trying to grow again and re-establish themselves in their markets, it's making sure that there's adequate funding there for that to happen as well. So I think it is about survival, quite obviously, but also it's about growth too. I think there's for cash reserves and businesses to be so heavily depleted through this next few months, but for those businesses to survive would be, in some respects, an achievement, but also what you'll end up with at the end of that is a business with their cash reserves to build back up and grow. And so I think the question is really more complex than just trade, just survival, and that's what are sort of the themes of things that I go on to talk about here. So that's how I sort of see the context of this from a cash point of view. The reason cash flow planning is so important, and actually it's very, very complicated now, is if you maybe compare this to the last recession in 2007, 8, 9, you could almost model that out more straight more simply. You could say, oh well, maybe the sensitization of this is my revenue will drop by 20%. What do I do? I think this is an awful lot more complicated than that, because it affects supply and demand. Businesses not producing or not selling as many services as they used to. You have on the demand side people not buying as many products or buying as much service, and there's two very complex things to understand there. You've got working capital cycles that have been really impacted by this. I think at the extreme, and we've certainly seen this as a business ourselves. If people just aren't paying, people just are just conserving cash and just aren't paying either what they owe when they owe it, or anything at all, or they're paying small amounts over a period of time. And what you end up with there is everyone's sort of holding on to their cash, if you like, for understandable reasons, but it's just not flowing around the market. So there's a real big liquidity squeeze in the market at the moment that affects working capital. And then the sort of fourth leg, you've got supply, you've got demand, you've got working capital being quite upset. And the fourth leg is there's a lot of government intervention. Some of it's grants, some of it's deferrals, some of it's reliefs, and each of those has a cash impact too. If it's grant income through furlough, for example, when is that received? If it's a deferral, well, actually, how long is that going to be deferred for, and when's that going to become relevant again? And when you're trying to model out supply, demand, deferral, and a really effective working capital cycle to work out what your cash balance is going to be at the end of all this one, it's a really complex picture, and I think it's a lot more complex than 7, 8, 9, when that was just a little bit more about an overall sort of slowdown in general global markets. So it's a really difficult question. Whether this presentation is going to address all, give you all the answers to that, I just don't know. But I'll give you just two, a couple of approaches to it. In helping some various businesses sort of apply for funding packages, or just helping them work through some of the questions I've sort of raised there. There's two types of forecasts which I think are sort of most relevant, and certainly this first one, which is on the screen here, which is the sort of 12 or 13 week cash flow forecast, is very it's probably, in my view, the most important thing to try and get right, and this is as opposed to what I'll talk about in a little bit of time, which is a longer term 2 or 3 year recovery plan. I just feel like the shorter term cash flow forecast is certainly the one I'd give a lot of time and attention to. And the question is, well, why is only 13 weeks? It's a reasonably random period of time. Is because for a business to predict detailed cash flows for any longer than 3 months is, in any stable market, very, very, very difficult. In this market, it would be practically impossible to do. So I think 12 or 13 weeks is sort of the maximum amount of time I think any business would have any chance of being able to get this right over. And it also includes sufficient window of time for, I don't want to use too much accounting wording here, is if you have your opening balance sheet, which sort of summarizes as of today, for example, your debtors, your creditors, your stock, your cash, and other accruals and payments and things. Over the course of 3 months, you would expect a lot of the working capital there to unwind. So I think 13 weeks is a good time period. It's probably predictable, and it gives you long enough to work through your current state of affairs and how that's likely to unwind. And certainly, if you were to apply for any sort of bank support here, even if the government's there guaranteeing it, you will be asked for one of these. So I thought what I'd do, and this is ever dangerous because I'm going to try and bring a spreadsheet up midway through it. We've got on our website, and this is not a plug for UNW because it's totally free, and we've had thousands of people sort of access it and use it. But I just thought, well, to make this more of a useful session for people rather than me talking about concepts, I'll just really quickly give an example of a 13-week cash flow forecast, the sort of things that we would generally work into one of these. If you haven't done this already, or you want to use this one, just grab it from our website and start playing with it. So, and I won't go through this line by line, but just to give you an idea of the sort of things that should be put in here. What this would include is your opening cash balance, so where you are today, and I'll just assume 10,000. Where you're going to get your money from, and there's various categories here. It's your debtors, so people who owe you money today, when you realistically expect them to pay over the next 13 weeks. New business that you've got from your existing pipeline, so it's maybe business work you're working on at the moment, it's work in progress. How do you see that being invoiced? But then more importantly, how do you see it being paid as well? It's the new business, and I think this is probably slowing down for a lot of businesses now, is those things we don't know about yet. Do we think we're going to win them? And if we do, when are we going to start getting paid for them? I won't go to detail, but you might have invoice discounting. You might have an unusual VAT relationship where you get VAT repaid to you. You might have government support here. So if you're having furlough payments and they're being received 6 to 10 days after it's been processed, so the portal is now available to do that one. You might have lump sums being received through grants on furlough arrangements. And you'd end up with total receipts. Against that, any physical cash payments that are being made, including wages, salaries, and overheads, etc., go through here. And this isn't necessarily when you receive the invoice; it's when you're physically going to pay it. I'm trying to capture here, and it goes through lots of lines just to prompt you to think about what runs through a business. any fixed assets that people are buying. I would expect that's probably slowed down quite a lot at the moment because they can be quite material purchases. And what this will end up with here, and I'll just sort of quickly zoom into a graph, is, if I can make this bigger, I will. It's something like this line here. Wait, this is just sort of closing cash balance every week. I've assumed that this company's got a £5,000 overdraft, and it will show you at which week or which point in this 12-week cycle the overdraft's not going to be enough, and actually what the total, in this case, what your total funding requirement might be. So I think they're really useful. I think they're quite can be very diligent exercises to prepare that sort of cash flow forecast. And I would really recommend, even if businesses feel at the moment that they have enough cash, that they would go ahead and do that. So longer term, and this is probably I wouldn't say as important, but it's, it's going to be a little bit less important, but still really worth thinking about, is maybe longer term forecasting, how you see the businesses recovering, not necessarily in the next 3, 4, 5, 6 months, but really going out the next couple of years. And certainly if businesses wanting to access debt finance, this aid for the bank, but also for the company owner or directors, is an important exercise to go through. And I could talk about this for an awful long time because there'd be incredibly complicated models around this one. But the top tip I would give is, if you're doing a longer-term forecast, just make sure it's as flexible as it can be, because without almost unless you're incredibly insightful, it's the forecast you land up with this weekend, if you were doing one, is just one possible scenario, and almost inevitably it's not going to be right. So the more you can flex it and look at downside and upside situations and work through a range of funding requirements, the more value you'll get out of a longer term forecast. The cash flow one is just a cash flow. It doesn't look at profit. It doesn't look at the balance sheet in any great detail. This one should. I think a really good forecast should be integrated cash flow, P&L, balance sheet. Certainly from a bank point of view, they're not just going to run on P&L. It's going to have a cash flow as well. So these things take a little bit more thought, and I think are really useful business management tools anyway, almost regardless of the situation we find ourselves in today. What both of these things should determine is whether there is a cash gap and a funding need that needs to be filled in, which sort of leads me sort of nicely or neatly or purposefully actually into, if there is a cash gap, what can be done about it, and what are the options that the government's making available to businesses to try and fill those in at the moment. This presentation doesn't talk about necessarily VAT deferrals or rate rebates or rate deferrals, but it does talk about some of the government bank schemes that are available. I'll touch on two of these ones. I probably won't touch on the middle one because that's for quite large corporates. But the one often talked about right now is CBILS, which is the Coronavirus Business Interruption Loan Scheme. Really topical scheme. What it means in a nutshell is that a panel of lenders, which are sort of approved by this government agency called the British Business Bank, have access to government guarantees for 80% of the money they lend to qualifying businesses. And that guarantee enables those lenders to lend money to businesses throughout this crisis, whereas actually without that behind the loan, they probably wouldn't do it. They'd probably classify it as being too risky. So its purpose is to try and free up lending in a market where otherwise lending would be very, very hard to get hold of. There's beneficial terms for the business who get it. It's interest free for 12 months. At the bank's discretion, but I'm seeing most of them do this, it's normally capital payment free for 12 months too. There's no arrangement fee charged for it either. And the money can go out for up to 6 years, which means that the maximum term of the loans, and the loans could be an overdraft, could be a loan, could be what's discounting. But the maximum term of a term loan is 6 years, and it's slightly lower for some of the other products as well. So a lot of them, the vast majority of the main high street banks are on this panel and are starting to lend money through CBILS. And a lot of businesses, I think not as many arguably as everyone would like, but a lot of businesses are now starting to access this debt with guarantee behind it. It is unfortunately debt. It's not a grant. It's long-term commitment the business is taking on. and it needs to be repaid, albeit maybe over 6 years' time. So it really needs some careful thought there. But it's my own view of it is it's a good scheme, and it's good that businesses can access it. And I won't go into too much the detail of what can and can't work now, but I can if anyone's got any specific questions about that. There is a larger scheme there. That the smaller ones, the CBILS, is for businesses with a turnover of less than 45 million. There's a larger scheme for businesses with a turnover of greater than 45 million. It's less beneficial there. It's 3-year terms. It's commercial interest rate. We will get charged an arrangement fee as well, but it does come with an 80% government guarantee. So again, bigger businesses can access those loans with that guarantee behind them. And there's something that's announced actually this week, which is going to come into place next month, so probably early May. It's called the Future Fund. Now, in subject CBILS is relatively straightforward. The Future Fund isn't. This is quite complicated, and this is designed to capture mainly innovative businesses that aren't eligible for CBILS, and that's normally because they fail on some sort of eligibility criteria about how profitable they've been historically, or the state of their balance sheet. And there's a few things there that get caught around viability. If a younger business or a innovative business which is growing just doesn't have that core profitability or viability, then Future Fund's an option. That's a £250 billion pot of money, and the government's putting in, and this is complicated, but I won't go into too much detail, but it's a bridging loan, so it's debt, priced at 8% interest, alongside a matched funder, which could be another institutional investor, maybe like a venture capital fund. And that gets provided to a company, and it's convertible. So if the business is sold or it goes to another fundraising round, it converts under a certain formula. Or in fact, it could also be repayable, but at quite a premium. So if you borrow, let's say, £250,000 through this scheme, there'll be 100% redemption premium attached to that one. So you'd pay £500,000 back plus interest if that weren't converted into equity. So quite expensive. I think it's quite interesting actually. For some businesses it will be good, many businesses it won't be appropriate. But these are the 3 main schemes the government's announced around funding support for businesses. And as I say, certainly CBILS is, if businesses can access it, it's actually got quite a few strengths around it, whilst there's also some negatives as well. So that was a bit of a canter through some aspects of forecasting, modelling, and some of the government schemes available. I'm really happy to talk in detail about any of these schemes and probably what sort of pitfalls are, what the good things are, things to look out for. But I'll probably just wait for questions on that. But what I was going to say next is, outside of the government schemes, there are also funding pockets available too. The venture capital market's not shut, that's still open, as is private equity. But both of those quite big markets really in the main are being extremely cautious. They're equity investors. They are very concerned about the value of the shares that they're buying, what they're worth now, what they're going to be worth in the future. So those markets have slowed down, and in fact the Future Fund's really about trying to speed up the venture capital money in particular. But they're still there and they're still viable. I think things like the Business Growth Fund, which is sort of targeted growth capital support for large businesses, is more relevant now actually than probably was before. I think that sort of scheme or fund would be well worth thinking about. So there are other funds out there, but I think they're all being, those who are investing equity are being a little bit more careful now about what they're buying and how much they're paying for it. So most focus now is on these government schemes where they can be made to work. So that's a bit of a kind of through, Adrian. I'm not sure if that's if you've got any specific questions there or not, or you want me to sort of keep going on some of the detail.
I think, John, that's absolutely brilliant. I think for all of us really, that gives a really good sort of overview of the breadth of what the government are offering and some really excellent insight into what's going on. So thank you very much indeed for that. And top marks for Zoom on-screen presentational skills as well.
No, I was quite impressed myself with that, actually, with old Zoom, yeah.
So think what we'll try and do now then is go to our questions, and luckily we've got one or two pre-asked. So I'm going to go straight to our nursery, and they're really getting their money's worth and asking 3 questions. So I'm going to read these out, and then hopefully those of you who are watching this, if there are areas that you would like to get some help from John in, then do please use that Q&A to ask your questions.
If I get a difficult question, I'm just going to sit here really still and pretend I'm frozen until you ask me an easier one. I just want to be like,
right.
pretend I'm in freeze. But go on, let's see if we can tackle the nursery one.
Got it. Okay. We are a non-profit making cooperative. Our business is in the childcare sector, and we have concerns for sustainability. The majority of our families can't use the nursery. We are open to key worker parents only, and therefore to maintain some income, we have reduced parents' fees by 50% and have only 19% income from the government free nursery education funding scheme. Therefore, we're able to claim from the furlough scheme for 11 staff, 28 still working. We will be at a loss of £70,000 come August if we don't resume normality by then. How can we access funding support?
Yes. So there's nothing. The answer is yes. Actually, there's nothing to stop nurseries or not-for-profits or not-for-profit nurseries accessing the schemes I've just talked about. But I'll give you a couple of buts, or things to just be a little bit wary of. Is what's happened so far is banks have been absolutely inundated with requests for funding through CBILS, and that's given rise to a couple of sort of unintended consequences. One is that they're just focusing on their own portfolios at the moment, and you'd be incredibly lucky. In fact, it's not seeing it. I haven't seen much switching of banks to access CBILS, whilst theoretically you can do that one. Most banks are really focused on their own portfolio, and they're closed to new business, which I understand. That will change over the next few weeks and months, and CBILS is around until the end of September. That's not going to be any help to this situation. So if this nursery is with a CBILS lender, and unfortunately there's no guarantee that is the case. A couple of lenders like Handelsbank and Allied Irish, for example, are not CBILS lenders. I'm sure they're trying to become one. That's a real problem, because if you're not with a CBILS lender and you want to try and access CBILS debt, which I would recommend a good idea, you're more limited in your options to try and get hold of this funding quite quickly. There's people like Funding Circle have just come on to the CBILS scheme who clearly don't have, not clearly, but they don't have a huge list of retained clients who've been more open to applications. But the first things to work out is just through the British Business Bank's website, is your current bank an accredited lender? And let's hope they are, because most of them are. Okay. The second reason that this could be difficult, but let's hope that's not the case, is the viability of the businesses. So this is obviously not for profit nursery. To access CBILS debt, the bank needs to be comfortable that when hope things do get back to normal, that the nursery in question can service the debt that it's taken on. So is it sort of, doesn't have to be viable throughout the sort of COVID period, because many businesses aren't going to be viable, but the measure is, was it viable before? So if you take the last year end, say it's year end of December 2019, whatever the business managed to deliver them, could it have actually sustained an amount of debt in that trading window? If the answer is yes, actually the CBILS application should be positive. Okay. The next challenge is, say banks are inundated with requests for clients, and actually a not-for-profit business, cooperative, childcare is probably on the difficult scale versus a normal SME where you can get your mind around it. So, is a bank the best solution for this one? And it might not be, but there is something. You should look at something called the SIB, so social. The Reliance and Recovery Loan Scheme, it's called. which is run by Social Investment Business, which is SIB. So that's a CBILS lender, just out there for not-for-profit. So it's using big society capital money, and so they're doing commercial lending. Same CBILS criteria apply, just for not-for-profits though, and they understand not-for-profits. I would imagine, I respect, better than a normal bank would be. So I'd have a look at Social Investment Business and see if I can apply through those guys for a CBILS loan in the first instance. There's no reason why a cooperative can't do that one, just providing the business can pay back the debt when it's taken on. And I think in doing that, you might just circumvent some of the other areas where you can get a little bit stuck in the mud with a traditional bank. But I'd go from an incumbent bank, I'd go to SIB, and I'll see if that works, and hopefully it will. There's no technical reason why it shouldn't, I don't think, that I can see.
Okay, John, thank you very much indeed. There was a related sort of supplementary question from the same person, actually, which was asking whether or not they were at a disadvantage because they were a cooperative company. I mean, is that a big issue, do you think?
No, there's not many businesses or types of organisation are not eligible for CBILS. So no, I don't see any reason why that wouldn't work for a cooperative. Things like state schools aren't eligible, or banks aren't eligible, but it's quite a small list of businesses that aren't eligible. So I don't see any reason why that would be a particular problem for a cooperative.
Okay. And I think also that the person who asked that, there was another question relating to business rates, which actually I think, John, in fairness, might not be a sort of fair question to ask you, but actually there's someone on my team who for the nursery will get in touch with you afterwards, so we can help you with that.
Let me know. There is, I mean, I was chatting to one of our charity partners earlier who looks at, there is a problem, I know, with rate grants where if charities take rate relief because they're a charity, it's not that clear whether or not they could also get the grant, the £10,000 grants that are coming through. I think there is if you have someone in your team who could help with that, that's probably the way to go for that.
Well, we'll have a look at that. We've got a question that's come up on the Q&A, so let's take a look at that. How do you see these loans affecting businesses post-COVID? The loan terms appear quite short for the maximum loan amounts. Does this imply the government anticipate a particular shape recovery?
It's a very good question, and I'm very pleased. I was talking to a bank this morning, and this very question came up, so I can almost use that conversation as a way of answering it. I would certainly agree. The large business loan scheme only comes with a 3-year term, which I think is quite big. It's up to £50 million worth of debt. That's quite a short repayment term, and I can only expect or anticipate that that's because it's the banks or government are hoping they're refinanced out quite quickly. CBILS, as I say, is 6 years for a term loan. The scheme that came before it was something called the Enterprise Finance Guarantee. So the CBILS basically uses the same rules, most of the same rules that are applied to the Enterprise Finance Guarantee. And that was introduced after the last recession in 2008-9. And the EFG, interestingly, was 10-year money, so that was 10-year term debt, which would be, in my mind, if CBILS were guaranteeing term loans extending for 10 years, if you're taking a loan amount, dividing it by 10 as opposed to dividing it by 5 if you include a year of capital repayment holiday, you can see how businesses would have an awful lot more headroom to satisfy that over a longer period. So it's a great question. I mean, had I not had that chat this morning, I would have struggled with that one. But I totally agree that if CBILS was 10 years, then I think it would take a lot of pressure off businesses. I don't know why they've reduced it down. I wonder if it's because they're expecting such a lot of money. This is a £330 billion fund to be deployed under CBILS that actually just purely from a freeing up of capital point of view, they're hoping businesses just can get through this or refinance it on more standard terms afterwards. But where I wouldn't fall off my chair if when the cover repayment windows are up on a lot of these loans that are going through, if the term might be extended. But you couldn't guarantee that one, but it'd be quite a sensible step to allow that to happen. But it's a good question. Do I think that's linked into the expected recovery? Yeah, I probably do. I mean, I certainly think the 3-year larger business term length is must be linked into how realistically the government expects the recovery path to go, and when businesses come out of this one. The fact that it's been brought down from the 10-year EFG to 6 is meaningful to me in some respects. So yes, I do think it is. Let's hope it is linked into the expectation of when things do get back to normal. But that's just my guess. I haven't heard that from any official source.
John, I guess, I mean, linked with that, and just thinking back to your presentation and your 13-week cash flow forecast, and I would guess, I mean, certainly for us at NE1, there's sort of 55% of our member businesses operate in retail, leisure, and hospitality sectors, and I would think quite a lot of them are going to be, as you said right at the beginning, guarding cash very, very carefully and looking at their cash flow over the next few weeks. I mean, in your experience helping businesses, I mean, how long is it typically taking to get a CBILS loan?
Again, it's a good question, and almost the irony of it is bigger businesses, with an established relationship manager or director at a bank, are probably from start to finish 2 or 3 weeks is the timeline. And whether that, actually must say, whether that's perceived as being too slow, I don't know, but that's the reality of it. I think the population of businesses that are most struggling to get applications through quickly are smaller businesses, maybe looking for sub £250,000 worth of borrowing, and they don't have dedicated managers or directors who look after them. And obviously I'm aware, and people would have read that there are unfortunately thousands of these businesses in the system trying to be processed, and whereas I said bigger businesses maybe 2 to 3 weeks, I mean probably 2 to 4 weeks is the timeline for smaller ones who are stuck in these bigger queues. I'm very aware and mindful that banks are trying their best to get through these applications, and they're shortcutting credit decisions and getting more autonomy to teams who make credit decisions, and all this stuff is really, really going to help. But I think there's just big demand that's trying to be waded through. But that's about the time. The application process actually isn't that complicated. As more precedents are made of unusual situations that come up, the credit decisions are also quite quick. I know credit decisions underwriting decisions don't have to go all the way up to credit in many cases now too. So then loads of processes and systems are either in place or being put into place to make this quicker, and it's certainly getting better, and hopefully much easier for people to access.
I think I think with related to the whole area of loan finance, John, I mean, what's your sort of experience of people's kind of success rate in managing to get a loan? And I think there's also something there around people having to give personal guarantees as well, because some people have an appetite for that, and others perhaps less happy with it. Is there something you can tell us about that?
Yeah, I mean, the point in some sense, probably slightly different questions, but the first one around the success rates on applications, or the ones that I've heard have failed or I've been involved with and have failed, it is generally because the business has failed to meet almost a binary test of, was it profitable in the last financial year, and therefore able to service debt based upon those financial results. It's almost, unfortunately, if the business isn't generating sufficient cash in that historic window to service debt, it is, I'd say, incredibly hard, almost impossible, to access CBILS. That's really, and that's probably where things like the Future Fund might become relevant for them. And I certainly haven't personally been successful in talking my way out of that one. It is a really difficult test, and businesses just aren't succeeding through that one. I don't know what percentage that would account for. I was chatting to one of the banks this morning, just randomly. He'd had 20 applications, and one of his he hadn't been able to push through, and actually that was because of profit as well. So that's a really high success rate. Granted, it's just one random example. So I think where, well, I know where, if the answer can be yes, the answer is generally yes, and we're working really, really hard to say yes. The second one on the personal guarantees, and that was when CBILS was first announced 4 weeks ago. It was really quite controversial, this, and it certainly it slowed the start of the scheme down quite a bit, where directors and shareholders were being asked to give personal guarantees to cover lending, and that's to mitigate the bank's risk on, I guess, their 20% of exposure they have on bad loans. Some banks just said, no, we're just not going to ask for personal guarantees because we don't need to or want to in these bad circumstances, which was really great. Then the government came in and worked with the banks to take away the requirement, or banks cannot ask for a personal guarantee for CBILS loans of less than £250,000. In fact, they don't even take a company debenture under £250,000. So that really freed up or made more accessible those smaller loans. And then for amounts over £250,000, it goes up to 5, so £250,000 up to 5 on the smaller scheme. The banks can take PGs, and it just covers them. The person giving the PG would be exposed then to 20% of the debt in the event of the unrecoverable debt in the event of an insolvency. So that's more limited than it was before, even though it doesn't sound great. It can't be over their private residence, and actually, whilst banks can ask for that, still some of the bigger ones, so some of the bigger banks are still not requiring PGs for those bigger loans either. So I think a lot of that's been worked through. The more quite hotly talked about topic this week, and there's some rumours in the FT this morning that maybe next week this will change, is government at the moment extends, and it's sort of very off to a question you haven't even asked yet, but it's sort of on my mind. I was talking about that, but the government at the moment guarantees 80% of the debt, which means the bank's exposed for 20% of the amount that can't be recovered as debt. And that means the banks are quite careful, because they don't really want to be taking a 20% being as diligent as they can be in the time that they've got to protect themselves against that one, and taking PGs and stuff. What earlier this week, the Chancellor said that there's a lot of pressure on him to say for sub £25,000 loans that the government guarantees 100% of them. So there's no recourse then to the bank in the event of that loan. And he sort of resisted that at the beginning of this week, but I've sort of been reading the FT this morning that maybe early next week there might be an announcement where the sub £25,000 loan, and there might be caveats to this, government would extend its guarantee to 100% of it. And what that will do, and particularly for SMEs, where 25,000 is a really meaningful amount of money, it means that the banks will be a lot faster. I'm not saying the banks will be throwing money out the door or whatever, but they'll be able a lot more quickly, with a lot less paperwork, to deploy smaller £25,000 loans to businesses where the government's standing behind them. And other countries seem to have done that reasonably successfully. So that will be a really big change. And when I've said, it's getting quite slow for businesses who don't have dedicated banking support, because not enough people to deal with it, this could be really beneficial and clear up a lot of smaller applications and get them through. So sort of a bit of fingers crossed. I can't guarantee that one, but it's really worth looking out for early next week if there is an announcement about that.
I think it is very interesting, isn't it? Because there are cut-offs and sort of limits to various things. I mean, one of the things that we've been helping with, which is a sort of UK or an England bid industry initiative that's been launched this week, and actually does seem to be getting some very good traction, including with questions being asked by MPs, is called the Raise the Bar. Right. And you'll be aware that retail, leisure and hospitality businesses with a rateable value between £15,000 and £51,000 can access eligible for a £25,000 grant. And of course, we've got businesses that are literally, they're kind of like a penny or two over the limit. Yeah. And actually, they're therefore not eligible. And actually, there's a movement afoot at the moment to try to get that boosted to £150,000 rateable value. So we'll have to keep our fingers crossed and see where that goes.
Yeah, it just illustrates, doesn't it, how I've sort of seen through things like the CBI or MPs, etc., that lobbying does seem to have quite a good effect on some of these schemes that have been necessarily rushed out. I think like the self-employed one as well, quite rushed out, and I'm quite actually think that some of them have been rushed out very, very well and very effectively. So I'm quite positive about a lot of them. But you clearly, as then when they're established, things come out the woodwork that just don't quite work. I'm sort of quite pleased that things like Siebel's is a good example where things haven't quite worked. They've been changed and moved to accommodate as many people and businesses as they can. And that, what you just said there, is another great example of, well, let's keep our fingers crossed. But sensible lobbying hopefully might have a great effect on that, what you just mentioned.
Well, John, I think if we might do one more question of mine, and then if there's nothing else coming up on the Q&A, I'll let you get back to your clients because I'm they'll be wanting you. So perhaps, and I know you did mention it in your presentation that some banks were trying to become Siebel's lenders, but they weren't currently. And it was really just that, thinking about the smaller businesses that are in those sectors operating in Newcastle, if they would like to take advantage of Siebel's, but they're not actually currently banking with a Siebel's lender, I mean, what's their sort of next steps?
So two routes there. If the requirement is immediate, and really an application, I've just said, let's say it's a 2 to 4 week timeline. If the requirement's immediate, go to the British Business Bank website, just click on the accredited lenders that are on there. And I'm afraid you might have to, in the first instance, avoid the better known banks that you'll see on there and look to the almost the challenger banks, if you want to call them those. And you may not know who they are, but things like over North have been put on there, funding circles going through there, and there's a bunch of others you'll see. You may not recognise what they do. It's more likely today that those less established banks will have the time and capacity to look at applications. So the need is urgent. That's the route I'd go down. If it's not, and as I say, this is open until September, what we're expecting is that the current bigger banks who are wading through these thousands of applications will eventually get through them over the next sort of few weeks, hopefully. And then they will be, I'd have thought, open for new business again, and actually quite keen for new business. That's obviously what they're all about. So I would then flick on to those more known banks and just apply through the more traditional route there, because there's no with Siebel's, I may have said this before, but there's no requirement for you to get your Siebel's supported loan through your incumbent bank. It's just the path of least resistance at the moment to do that. In a more if the market wasn't so busy, you'd probably want to go and talk to a few of them and just work out what different terms are available from different banks and what the personality fit might be with them, etc., etc. So you'd rather go to a few than just one, probably. You can't do that yet, but give it a bit of time. You will be able to. Otherwise, you'd have to look to the non-mainstream lenders. And I mentioned funding circles. It's really unusual. It's a good and bad example. They'll follow Siebel's terms for 12 months, interest-free and probably capital payment-free and no arrangement fee. If you stuck with them, though, you'd probably flick onto quite expensive sort of funding circle debt, and that would be versus a mainstream bank, quite expensive, and you really wouldn't want that for too long. So it's not a perfect. What I've suggested there isn't a perfect solution. It's just what you can do at the moment, and I'd almost say that those businesses who aren't with the Siebel's lender are probably in a difficult position for the next few weeks, and let's hope that gets better. And actually, I should mention the British Business Bank are always putting on. Always trying to put on new lenders, and loads of lenders have applied to become Siebel's lenders. And every week, without question, you'll see more lenders coming onto the Siebel's scheme. And I'm sure those big banks who aren't on it will be applying as quickly as they can to become a Siebel's lender. So also watch this space with the British Business Bank too for new people coming through.
John, thank you very much indeed. I think that's been a really, really interesting session. I think we'll draw stumps there. So on behalf of everyone who's been taking part this afternoon, thank you so much to you for your detailed and very expert answers. For a number of years, I've been wondering what UNW stands for, and I haven't delved too far into what that is. But actually, one of your colleagues told me a little while ago that it stood for uniquely nice and welcoming. So I think that's a great way to finish off on a Friday.
That'll be better than me giving you the actual answer, which is incredibly boring. So we'll take that, and it'll be a nice way to wrap it up.
Well, John, thank you very, very much indeed. We will record this later on, and we'll put that out onto the website. So actually, I've just seen a question coming up. So would it be possible to have a copy of the presentation slides? I'm sure it is, and we'll
happy to, of course,
put you in touch for that.
So
the
slides go on to say, so the slides go on to say, if you're applying for CBILS, it sort of lists out what sort of information you should pull together, which I think is actually quite a useful reference point for anyone who might want to go down that route. So do feel free to click through them at your leisure.
Brilliant, thank you. And I think just for those of you who are still there, just a couple of plugs for NE1. If you have a vacant or a closed premises in the city centre and would like that to be checked every day, our street rangers are providing that service at the moment. I think we're up to about 90 or 100 premises checks every day. And if you are operating in any way, shape or form and would like some support with marketing and promotion, please get in touch with us. The email for either of those is info@newcastlene1ltd.com. Thank you again, John, to you. Thank you very much indeed for all of you who've been listening to us this afternoon. Have a great weekend. Thank you.
Thank you.